Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's podcast, we're going to dive into three superb questions from three super smart individuals. The first will be about using funds in a self-directed IRA to make an investment and ultimately needing more money to pay for a real estate expense. What do you do? Second is if you have a IRA LLC and need to pay for travel expenses to view a property. Can you do it? How do you do it? And then thirdly, the question involves how someone could potentially add more money to their retirement savings through piggybacking off a spouse's business to add money through a solo plan. So it's going to be a really fun episode for you. Buckle up and let's get going. First question from YouTube. I have a self-directed IRA LLC which owns real estate. I need to come up with around $6,000 to pay for a new AC. My IRA is only $2,500 left in it. What are my options? So this stuff happens quite often. Okay, you roll money into your IRA, you buy the asset, and things happen, right? You have improvements, landscaping, whatever, and the money kind of in the account starts dwindling, and now you have a major expense like an AC unit or a heating unit or roof leak, whatever, and you need to come up with some cash. What do you do? So first option is you have the opportunity to add more money into your IRA. In 2023, $6,500 or $7,500 if you're over 50. Your spouse can do that as well. So technically, it could be at least 30K. It could be 15K or 13K or so. So you have options. Now, let's say you don't have that ability because you make too much money and you can't do a pre-tax IRA. Well, you can always do a backdoor Roth IRA, which will also give you that $6,500 or $7,500. So if the AC unit is 6K, you can put in $6,500 or $7,500 if you're over 50. What happens if that doesn't work out? Well, depending on your age, if you have a 401k at work and you're over 59 and a half, you should be able to roll some of those funds into an IRA and cover these expenses. If you have other IRAs, HSAs, covered Ales, you could be potentially use those funds to add or lend those funds to the LLC or even invest in the LLC to add funds. You can also borrow money from a non-disqualified person, a non-lineal descendant, or a non-entity you control. So brothers, sisters, aunts, uncles, friends, cousins, all those folks are fair game, and that could obviously help you cover any shortfall. Now, if you do borrow money, note that there could be UBIT, which is a tax on more than $1,000 in net income attributable to the loan. But if it's a short-term loan, you're borrowing 6K, 12K, 15K, you're going to pay back within a year. The UBIT issue is probably not very material. So the individual that asked this question is a great one. It comes up a lot. That's why I always say if you are going to buy real estate, keep a little extra cash in the account. Give yourself a cushion because stuff happens. If you're a homeowner, there's always something every month. It's like, oh, that I got to pay for that now. So I get it. Second question from Harold T. of Ogden, Utah. And Harold wants to know, I have a checkbook IRA LLC. As manager of the IRA LLC, can I use IRA funds to pay for travel expenses to look at a potential property I want to buy in Mexico? Well, good choice. Mexico is better than Milwaukee. So good job, Harold. Okay. You got to be careful. So under the tax code, under 4975C, it says you're not allowed to provide services to your IRA other than what's reasonable and necessary. And that's the reasonable and necessary is not in 4975C, but it's in 4975-6, the Treasury regulations, the proposed regs. And really, the reasonable and necessary is the basic stuff, like hiring a lawyer, hire an accountant, hire a contractor, deciding how much you're going to buy the house for, sell the house for, maybe what color the the roof will be. Like, you can make necessary decisions for your investment, but you can't do what's unnecessary, like paint the walls yourself or like mow the lawn. So clearly you have the ability to go and decide if it's a good investment, right? The problem is when you start mixing travel and entertainment and retirement accounts, it's very hard to segregate what is personal and what is retirement. Especially when you go to Mexico, maybe you're staying at a resort, hanging by the pool. It's awfully hard to show that you're only going exclusively for an IRA look. So it's tough. What people end up doing is just paying for it themselves. And you may say, Harold, hey, then that's not fair. I'm using personal money to benefit my IRA. Well, it's hard for the IRS to argue what you're doing, right? If you take a personal vacation, if you take a vacation to Mexico with personal funds, the IRS has no issue with that. Now, if you happen to go look at a property for your IRA, it happens. Just like if you take an investment course with personal money and you're using some of that knowledge for your IRA, that's just a byproduct of that use of funds. So I would much rather you use your personal funds to go to Mexico and check the property out than use IRA funds. If you use IRA funds, Harold, you're opening yourself up to potential attack. And then if you get audited, it's really up to you to show that, hey, I didn't have a Corona at the beach, and I went straight from the airport to the property and then back to the airport. It's awfully hard to do, and it's just I think it's not worth the risk. And plus, using retirement money, tax deferred money on a vacation, it's probably a better use of the funds to invest versus a couple of margaritas on the beach. So, Harold, I would use personal funds. Go to Mexico, enjoy yourself. If you happen to check out a property for your IRA, so be it. But that's the way I would structure it. So, great question, though. Really appreciate it. Third and final question of today's podcast from Brian L. of Tempe, Arizona. Brian wants to know, I work full-time and max out my 401k at work. Good job. My wife has a business that she runs herself. If she paid me, would I be able to make a contribution to her plan? So the answer is yeah, right? Because even though you max out, okay, the employee deferral is per individual. So in 2023, from the employee deferral standpoint, you can put away $22,500 or $30,000 if you're over 50. That's dollar for dollar. And that's per individual, whether you're part of 1 plan, 10 plans, 30 plans. Once you hit the $22,500 or $30,000, you're done. Now, there's other components to a 401k. There's profit sharing, which is 20% of your comp if you're Schedule C or 25% of your W-2. So let's say you maxed out let's say you work at, Apple, and you maxed out your $22,500. But now your spouse has a business that she wants to pay you $40K. Let's say it's an S corp. Okay, she could technically pay you the $40K, and she can do 25% of 40, right? Giving you another $10K. So you do the $22,500 at work, and now you have an extra $10K from your wife's business. Now, because you're spouses, your wife could have a solo K, and you could be an employee of that business without triggering any ERISA, because spouses are not deemed employees. However, you still got to pay tax on the 30, right? If you're able to get a $10,000 employer contribution, get the deduction goes to the business, so you're actually still paying tax on the full 40. But you also have the option of doing a mega backdoor. If you're a Roth lover, Brian, you'd be able to go almost dollar for dollar up to 40K. Now, because it's not an employee deferral, profit sharing is per plan, and the mega backdoor, since it's not an employee deferral contribution, is per plan, not per individual. So you can then do 22.5 at your job, and you can do, if you had enough income, 66,000 or 73,500 if you're over 50 into the solo plan with your spouse. And even though the 415 limit, meaning the total limit per plan is 66 or 73.5, because you have access to 2 plans and there's no control groups because you don't own more than 80% of Apple or your current employer, you can now do 66 or 73.5 in your spouse's plan, and also do the 22.5 at your full-time employer, giving you, above the 66,000 without triggering any issues. So the thing to remember is the employee deferral limits is per individual, but the profit sharing and the mega backdoor is per plan. So depending on your circumstances, it's not very common to have the opportunity to max out at work and also have enough money from a side business to also kind of double dip. But it's possible. And your example is a perfect picture of what can be done, because let's say you made 100K with your spouse, or 80K, and you're under 50. You can do the 22.5 at work, 66,000 in Roth, not tax deductible, but Roth. So now you're able to put away in a retirement plan 66 plus 22.5, 88,500, and have that money grow without tax. And once you're 59.5, and the Roth has been open at least 5 years, you can pull all the money out tax free, which is obviously pretty incredible. So great question, Brian, and really appreciate it. Thank you, Harold. Thank you to the individual who submitted on YouTube. If you guys have questions, send them in. You can leave a comment. You can send them to info@IRA Financial. Just say ADMAIL or Ask Adam. It will get to me, I promise. And it's fun. As I keep mentioning every week, I look forward to this podcast. It's a great way to kind of brush up on all my IRA rules, 401k rules. And I do learn a lot from this podcast. So I really appreciate all the questions. And if you enjoy it, please leave a comment, subscribe definitely to our YouTube channel, which you can watch this podcast and watch other videos we post. We generally post three videos or so a week. And you can also watch 2 other podcasts that I drop every week. If you're listening to this, well, appreciate it. If you don't mind, like would be cool. And otherwise, I'll see everyone again next week. Have an amazing rest of your day. And thanks again for listening. Ciao.